In 2008, while the global financial system was collapsing, trillions of dollars were evaporating, and even the biggest banks didn't know if they would survive the next morning, one man quietly invested $5 billion into a company everyone else was terrified of touching. He didn't panic, he didn't rush, he didn't break his rule, and that single decision would later earn him billions more. So what did Warren Buffett know that the rest of the world didn't? The answer lies in a rule so simple it sounds almost childish, yet it has made him one of the richest investors in human history. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is not just a quote, it is a philosophy, and today we're going to unpack what Buffett really means by it in a way any beginner can understand. To understand Buffett's first rule, we need to rewind nearly a century to the dust-covered streets of Omaha, Nebraska. This wasn't Wall Street, this wasn't Manhattan, this was the heart of Middle America, far from the noise of financial elites. Warren Buffett was born in 1930 in the shadow of the Great Depression. Banks failed, families lost everything overnight. The idea of safe money was shattered for an entire generation. Buffett watched this happen as a child, and it left a permanent mark on his thinking. While most investors learn fear later in life, Buffett grew up inside it. By the age of 11, Buffett bought his first stock. He didn't get rich from it. In fact, he learned a painful lesson early on. Price fluctuations can mess with your emotions far more than your math. That lesson would later evolve into his core principle. Risk is not about volatility. Risk is about permanent loss. This distinction is everything. Most beginners think losing money means watching a stock go down on a screen. Buffett sees losing money as something far worse, investing in a business so weak, so poorly understood, or so overpriced that it can never recover. When Buffett says never lose money, he is not saying stocks will never fall. He is saying your capital should never be permanently destroyed. And that mindset would later separate him from almost every investor around him. In the 1950s, Buffett met the man who would shape his investing DNA, Benjamin Graham, the father of value investing. Graham taught Buffett something radical for the time, that stocks are not lottery tickets, they are ownership stakes in real businesses. If you owned the entire business, would you be comfortable with its future? Would you sleep well at night knowing how it makes money, how strong its finances are, and how stable its customers remain? This idea led to the concept of margin of safety, the hidden engine behind Buffett's first rule. Imagine buying $1 for 50 cents. Even if things go wrong, you still have protection. That cushion is what prevents permanent loss. That cushion is rule number 1 in action. Buffett didn't invent this idea, but he perfected it. Fast forward to the late 1990s, the internet was exploding. Dot-com companies with no profits, no revenue, and sometimes no product were going public and doubling overnight. Everyone was getting rich except Warren Buffett. Media outlets mocked him. Analysts called him outdated. Even his own shareholders questioned whether he had lost his touch. Buffett refused to invest in what he didn't understand. He didn't know how to value these companies. He didn't know their true earning power. And most importantly, he saw no margin of safety. So he did nothing. Then came the crash of 2000. Trillions of dollars vanished. Entire fortunes disappeared. Companies once valued in the billions went to zero. Buffett didn't just survive, he emerged stronger. This is rule number 1 at work. Not avoiding losses on paper, but avoiding irreversible mistakes. Now let's break down what this rule actually means for a beginner. Buffett's first rule is not about being conservative, it's about being selective. He looks for businesses with durable competitive advantages, what he famously calls economic moats. These are companies so strong that competitors struggle to take their market share. Think of Coca-Cola's brand, Apple's ecosystem, or American Express's network. These businesses don't rely on hype, they rely on habit, trust, and scale. Buffett also demands strong balance sheets, low debt, consistent cash flow, predictable earnings. These factors act like shock absorbers during recessions, wars, and financial crises. When the world shakes, weak companies crack, strong companies bend, and then keep going. That's how you avoid losing money. The most misunderstood part of Buffett's philosophy is patience. In a world obsessed with speed, Buffett's biggest advantage is time. He once said the stock market is a device for transferring money from the impatient to the patient. Buffett doesn't trade, he waits, sometimes for years, sometimes for decades. When he finally acts, it's because the odds are overwhelmingly in his favor. This patience protects him from emotional decisions, panic selling, fear-driven buying, and trend chasing. These behaviors, not market crashes, are what destroy most beginner investors. Buffett's rule is not about predicting the future, it's about preparing for uncertainty. Nowhere was this clearer than during the 2008 financial crisis. As Lehman Brothers collapsed and AIG teetered on the edge of bankruptcy, markets were in free fall. Fear dominated everything. Buffett stepped in where others couldn't. He invested $5 billion in Goldman Sachs, securing preferred shares with guaranteed dividends and special protections. While others gambled, Buffett structured certainty. He didn't break rule number 1, he reinforced it. This wasn't bravery, it was discipline. He understood the difference between temporary chaos and permanent damage, and that difference made him billions. For beginners, the real danger isn't market crashes, it's overconfidence. Buffett has repeatedly warned that complexity is not intelligence. Many investors chase complicated strategies, exotic derivatives, and speculative assets they don't fully understand. Buffett does the opposite. He stays inside his circle of competence. If he can't explain how a company makes money in simple terms, he walks away. This humility is rare, and it's essential, because rule number 1 doesn't just protect your money, it protects your mind. There's another layer to Buffett's rule that's rarely discussed: behavior. Markets don't just test your analysis, they test your psychology. When prices rise, greed whispers that you'll miss out. When prices fall, fear screams that you're foolish. Buffett's rule is a psychological anchor. It forces you to ask one question before every decision: can this investment permanently harm me? If the answer is yes, you walk away. Not tomorrow, not later, immediately. Buffett's success has global consequences. His long-term approach has influenced pension funds, sovereign wealth funds, and institutional investors worldwide. His emphasis on fundamentals has shaped corporate governance, executive compensation, and shareholder expectations. Even companies change behavior when Buffett becomes a shareholder. Management knows they're being watched by someone who values integrity, long-term thinking, and capital discipline. Rule number 1 scales beyond individual portfolios. It shapes entire markets. As Buffett enters the later chapters of his life, his philosophy remains unchanged. He still believes most people should not try to outsmart the market. In fact, he has famously recommended low-cost index funds for everyday investors, a strategy rooted in the same principle. Why? Because simplicity reduces the risk of permanent loss. Buffett doesn't chase brilliance, he avoids stupidity. And that might be the most beginner-friendly lesson of all. So what is Warren Buffett's first rule of investing, really? It's not fear, it's not caution, it's respect for capital, for uncertainty, and for time. It's understanding that money is hard to earn and easy to lose, that once it's gone, compounding can't work its magic anymore. And in a world obsessed with quick wins, Buffett's rule stands as a quiet rebellion, slow, disciplined, and devastatingly effective. Because in investing, survival is victory. And if you never lose money, you give yourself the one advantage that matters most, the ability to stay in the game.